Friday morning. Welcome to Opening Bid. I'm Yahoo Finance Executive Editor Brian Sozzi. I want to be blunt right off the top here, friends. I have a lot to say about this Nike quarter that is hammering the stock here today. I think it sends a host of messages on one's investing process and on the broader investing landscape headed into next year. So here we go. Every analyst report I have read this morning is praising the Nike quarter as if the company squashed EP estimates by 50 cents and offered up guidance as if Michael Jordan was still playing basketball and you couldn't keep his sneakers in stock anymore. This wasn't the case at all. The quarter largely sucked, and so did the guidance for the current quarter. What is Wall Street seeing? No clue at all. But this is what I saw in the numbers and earnings call, and I'm just going to go right through it here. Very, very simple stuff. Quarterly sales up only 1%. Investors wanted more from a company being hyped by management as having its mojo back on innovation and execution for months on end. Nike direct sales down 8%. These are online sales and sales at Nike stores. Not great to see your online business struggling in the internet age, layered on top of AI innovation. Gross profit margin down 300 basis points year over year. This should be self-explanatory to you, but it reflects discounting on product, not selling, and oh yeah, Trump tariffs. Converse sales down 30%. I personally believe Nike will sell the Converse business. A lot of classic signs of this possibly happening. And this business still matters because it's still consolidated on their financial statements. Footwear sales down 21% in the former growth market that is China. That is absolutely abysmal. Sales of classic Nike sneakers, those styles tanked about 20%. Guidance for the current quarter whiffed badly versus estimates. Takeaways from all of this, you ask. Number one, as an investor, you should question a company when management is out hyping the business months before an important quarter gets delivered to public markets. Nike has in recent months been talking to journalists about their amazing new innovations coming like a jacket that self-inflates. Like the average consumer wants to see that in JCPenney. Who cares about this stuff? Let the numbers be your truth. Number two, Nike is indicative of what many companies will be dealing with out of the block next year. The reality of a sluggish economy and Trump tariffs against the backdrop of high market expectations. Possibly not a great setup to make absolute bank in markets. Here are my opening bid roundtable. I feel bad for these folks because I'm coming in hot. Art Hogan, B. Riley, Wealth Chief Market Strategist, alongside our very own Inez Ferre. Art, I'm coming to you. Every person that I've seen on the street this morning read all these notes, digested them all before 4 a.m. Everybody's so positive on this Nike quarter. I don't get it. Do you get it?
Well, I'll tell you this, it's obviously a multi-year turnaround story, and they're probably only about halfway through. So I think the fact that they actually did better in the U.S. in general and did terribly in China shows where they need to do most of their work and their heavy lifting. They are facing a ton of competition, and they really need to turn this story around. I think it's early innings for that, but I certainly think that if you were to say, is Nike going to be higher at the end of next year than it is right now, I would take that bet with you right now, Brian.
Art, can I just say I love your jacket?
Thank you very much.
I mean, that is so on point. I wish Nike was on point like your jacket. Inez, did you like this Nike quarter? Nike CEO Elliott Hill, he's been hyped. He's been in the seat, I believe, for over a year now. Where is the turnaround? He hopped on an earnings call last night, said the company was in the middle innings of a turnaround that I didn't see in the numbers. I just ticked through all of these things. Sales down, margins under pressure, guidance was not good, and I get that their running business is starting to pick up, and every analyst on the street loves to view this as a leading indicator for results, but the results that we got to digest last night were not good. There was really not a lot in them to suggest things were going to get better when they report 3 months from now.
No, I mean, as Art mentioned, China was really the drag here, and that's because of price point in China, because Chinese consumers are demanding better price points, and there's local competition that is in the space as well. And then you've got the likes of Adidas, On Holdings, Lulu, which is going through its own issues, but nonetheless, I mean, you've got a lot of competition, and the price point being a main drag here. You mentioned tariffs. Look, it's as Art has said, it is in the the CEO said it himself. I mean, they're in the middle innings of this turnaround plan. The question is Wall Street patient enough for the turnaround, for the recovery plan to take hold if they're in the middle innings? And if you take a look at the Wall Street, I mean, there are some price target decreases, but I haven't seen really downgrades yet. I mean, you've got 29 buys on this stock.
What are they doing, Inez? This is ridiculous.
Well, I mean, they are believing that you have to give him more than a year to do this turnaround plan. I mean, this has been a long time coming that the company has been has had difficulties in China. This is not like China has had its issues with its consumers. So this is not something that's going to turn around right away. But I mean, you are talking about a legacy brand that has to shift gears. So yeah, middle innings. And the question is, is Wall Street patient enough? The stock is tanking right now, so perhaps not.
Getting priced in real time. For the Yahoo Finance community that watches Opening Bid all day or any of our shows, we just don't show up here and pull things out of thin air. We have morning meetings. We plan these things out. And in our morning meeting this morning, our fabulous senior producer, John Hyland, had some great takes on Nike. He's hanging out in the control room. This is the host of Market Minute, Mr. John Hyland. I mean, I'll give you the floor, John.
Well, Brian, we were talking about this morning. You're talking about this turnaround. We're talking about share slumping. But forget the turnaround. I went to their website and I looked at the close and I said, what's changed from a year ago? I remember going into a Nike store last year thinking, great, I'm glad a new CEO's coming in. I hope we get some cool new clothes. Let's get some cool new partnerships. Let's do something fun. And I went to the website. There's not a single item of clothing that I want to buy on there today. And I'm just thinking, of course their turnaround's not working. They haven't changed anything. As an outsider looking in, I don't see a turnaround underway.
John, I got to ask you, how are you talking to me now and producing?
Well, it's hard to do both, but I was able to turn around the chair. I had to take my headset off so I could talk to you. But I mean, it's crazy. We talk about retailers that are doing well. You look at an American Eagle, they've got Travis Kelce, they've got Martha Stewart.
Who doesn't love Martha Stewart?
Martha Stewart?
Nike needs to team up with Martha Stewart. I'm buying Nike sneakers if Martha's wearing it.
Nike has Kim Kardashian, and they're coming out with the Skims. I mean, they are doing innovation on that end.
They had to jump in and they had to go for Kim because she was eating up their business.
So true, guys. Art, let me get you back in here. This quarter from Nike has me so upset. I'm not wearing my normal Nikes. I'm not wearing my Nikes. I'm doing the show in a pair of Allbirds, and that's how upset I am. Do you have any interest in buying Nike on the dip? And you can see my shoe there on the table. I'll put the other one up there for full effect. Or any interest in buying Nike on the dip here?
Yeah, I think you have to be very patient if that's going to be your game plan. I certainly think that a lot of the bad news, including today's downdraft, has been priced in over the course of the last few years. The big mistake that Nike made during the pandemic was going hard into direct-to-consumer and didn't pivot back when they should have. So they lost a lot of shelf space. At the very same time, Allbirds like you're wearing today, and all the other competition from Adidas and ongoing competition across the board has plagued them. They really need to innovate, and I believe they've gotten the message. It's just early innings on this. So if you're going to buy Nike, which I would today, you have to be very patient. This time next year, I bet we're talking about a stock price that has recovered.
All right, I'm also going off the rails. I had a long post this morning on my Instagram account going off on how expensive it has become to eat at Chipotle. And these Nike sneakers, they're not cheap either. Are you concerned about the health of the consumer next year and how it might impact not just the Nike, how it might impact an Arm & Armour, how it might even impact a consumer company like an On Running who's been doing well? I guess what I'm trying to think of, do you want any exposure to the U.S. consumer from a stock perspective going into next year?
Yeah, it's such a great point. And we continue to have this K-shaped recovery, which just basically means that consumers who are very choiceful this year and likely will be next year, and that's why companies like TJX have done so well, and Costco and Walmart, et cetera, are going to continue to be in that same place, right? The projections for both economic growth and employment aren't great. They're suboptimal heading into next year. I think we'll see a continuation of a consumer that's under pressure, especially at the lower end. So, if you wanted to invest in the consumer, we would point you to the off-pricers like the TJXs of the world.
And as I think it's fair to say that I will not be invited to the next media roundtable at Nike, and that's all good. Look, I get it. We're here to provide context analysis here at Yahoo Finance. But what I think this Nike quarter show, bigger picture here, is what I'm concerned about with many companies going into next year. The market's trading at, I believe, record valuations. A company like Nike warning about tariffs, sluggish consumer. It's like the market has forgot about these key risks.
Yes, and product innovation is so important. But I would note also that they did see a bright spot in North America. and also with respect to their running. So that is one point. And I would say that, I mean, I even went and bought some running shoes the other day at Dick's, $60. I didn't find that price point to be too terrible, but nonetheless, look. So
Inez, what sneakers did you get? Because I think that's you're like a leading edge, a leading
I think
indicator.
they're called Performance 8 or something like that. Women's 8, running 8.
So not Nikes.
No, they are. They're Nikes.
Okay.
They are a Nike brand, and yeah, they're a Nike. I thought that they were great for running, but you mentioned Converse, and that has been a major drag, and that you think that it's going to be that they may actually sell Converse, and I'm curious if you think that would happen and who they may sell it to.
Let me get back to my man John Hyland, who is I guess what, John, you're tapped into the Gen Z vibe.
Well, if you go on social media and you see what they're talking about, right now one of the trends is throw out your Nike tech and put on a quarter zip. So that is literally what
does that even mean?
Wall Street.
What is that?
This is what's going on social media. And I wonder, did the Wall Street analysts know this? And also, are those analysts who lower their price targets, are they wearing Nike to the gym? Or are they wearing Vuari? Are they wearing one of these startups? So are they wearing Nike? That's the question. But Gen Z right now, they seem to be going more business casual in terms of what they want to be wearing.
Look, I'm wearing my Allbirds today, guys. They're right on my desk. They're right here in front of me. This is what I'm wearing in the office. They're not Nikes today. They're very comfortable, and I can stick them in the washing machine and get them done. Art, back to you though. How concerned are you about unappreciated risks in the market? The market has forgotten about tariffs. And then I'm worried if investors are going to see more stories like Nike right out of the chute next year when earnings start hitting in late January.
Yeah, I would tell you this. I think that the tariff story is going to get thrown back in front of us when the Supreme Court comes down with a decision as to whether or not the use of the Emergency Powers Act is constitutional. So it's going to be brought back to the front page, and I think that is going to cause some concern, especially if the Supreme Court throws this down. Treasury Department has to return some money. The administration has to go to Plan B and try to sort out what powers they can use to finally get to the end point of what we all assume is going to be about a 15% average reciprocal tariff. So I don't think the tariff story dies. If, in fact, the Supreme Court rules that the administration was able to use this power, then I think we'll know that we'll anniversary those one-time price increases in the first quarter next year. That's not the biggest of concerns. I think the biggest concern is what's going on with the labor market right now. And we just don't have a clear picture. We're not creating enough jobs in this economy to keep unemployment from rising. And I think that's going to be the ongoing concern in the first half of next year. What is it going to take, and what are some of the drivers for why we're just not creating enough jobs and why unemployment's rising? So I think that's much more of a key risk necessarily than consumers being concerned about tariffs and price increases and everything being expensive.
Art, how are your portfolios positioned into year end?
We are a barbell approach, so we're equal weight, the artificial intelligence darlings, tech and communication services, and then we've, on the other side of that, we've balanced that off with exposure in industrials, healthcare, and financials, and they all have their own particular reasons why they're the offset to that, and that has done very well. It's forced us to rebalance that on a quarterly basis, but we're currently outperforming the S&P 500, and I think that's going to be a similar pattern going into 2026.
Art and Inez, stick with me. We're just getting warmed up on opening bid. John Hyland, you're the man. Thanks for hopping on. Coming up, we'll give the bottom line on the AI trade for next year. I'm going to go put my shoes back on because they look kind of weird on my desk. This week on Opening Bid, we have had our fair share of debate on AI and AI stocks, and one thing has been quite clear to me in the process: making money on the AI revolution next year may look differently than this year because the technology is broadening out. Here are a few hot takes on AI that stood out to me this week.
I don't know that it's necessarily a signal to start selling. Again, we're not trying to bet against that story. It's very secular, thematic, long runway, still very much early innings. So we're all in on it. I think just the reality of where valuations have moved to is a little bit, I don't want to say nonsensical, but I just said nonsensical. It feels like we need to recalibrate a little bit. And so I think what's happening here is some seasonality, selling some of those winners and hoping that we get another crack at it maybe early in the new year.
I think we're going to see some pretty massive bifurcation. So I think that's sort of the next evolution of this trade, where there are going to be winners and losers within the Mag 7. If I had to pick one stock that I think is probably my favorite, it's Google because of Gemini. And I think this is absolutely a code red for OpenAI.
I always say that that we are the company that is getting this AI benefit, because we're at the end of the bullwhip, and so we benefit. What's the end result? The end result is we've had a 10x usage in our models with a 25 to 30% reduction in cost.
So my question today is this: what is the future of the AI trade, and how are you playing it next year? Art, is it Mag 7 or bust for you?
It's not, and I'll tell you this, I think this was the year after 3 years of AI being rolled out and the revolution starting, where investors clearly had to start to differentiate. And the differentiation point really came to the fact that if you're spending massive amounts of money on CapEx to build out your large language model, that's fine if it's coming from free cash flow. If you're putting a lot of debt out there, your return on invested capital is starting to be called into question, and rightly so. We know there's 6 large language models being developed right now. We know there's not going to be 6 at the end of this revolution or at the end of the rainbow here. So the winners will have to be picked, and largely right now that's happening in a form of how much debt are you laying out to make this happen, and how long is it going to take to return that investment. So I agree with one of the hits that you just put on, and I think Google is in the lead. It goes back and forth between ChatGPT 4.0 and OpenAI. We really don't know if they'll ever come public, so that's not an investment opportunity. But where you want to be careful is in those names that continue to lay out debt. Companies like CoreWeave and Oracle clearly have been the poster child of you're spending too much money and we don't think you're going to get it back.
Are you unsettled by the valuations on some of these AI names?
Well, let's look at NVIDIA trading at 24 times next year's earnings. They've laid out what the demand is for the Blackwell, and they'll have another offering by the middle of next year. So clearly, they are at the tip of the sword of where the CapEx is going, and they're profiting from it in the here and now. So there's no question about their return on invested capital. So in that case, I'm not whatsoever concerned. Alphabet's trading at a reasonable multiple, 33 times forward, continues to have strong free cash flows, and all the concerns that we had about their relationship with with Apple. Now they're going to be a partner with Apple with Gemini, so that's going to be where your smart Apple Intelligence comes from. So, yeah, and those 2 names, no. I think when you move down the ladder and look at some of the names like Meta, Tesla, I don't throw into that basket because it's not exactly an artificial intelligence play.
We're still trying to figure out what Tesla is at this point, Art. You're not alone.
Yeah, I still, you know what? I think they're trying to figure it out too. It's always about the future and what they're able to deliver us. But I think the sneakiest of the AI plays is Apple, and continues to be. Everyone said they had no AI strategy. All of a sudden, they've delivered that. They've been blowout returns for the iPhone 17, and they're going to buy it. They're not going to build it. So, they're going to partner with Alphabet here, then somebody else internationally, and clearly they will be the winner. And that's how we'll likely consume artificial intelligence next year.
And as Art makes some really good points here, I am with him that 24 times forward earnings on NVIDIA is not stupid silly, and neither is 33 times on Alphabet when you have just dropped I would say, the best model, large language model, on the heads of everybody.
And those are clearly winners when Wall Street is taking a look at winners and losers. Look, Tom Essay's commentary was very on point. Nomura had also an analyst this week that was talking about breaking out the selective scalpel and basically the winners and losers that are emerging, and saying that that's actually a good thing. I mean, you saw Micron's earnings that kind of put the wheels back on the AI trade a bit after their earnings report. But Wall Street is seeing that, okay, maybe there is some scrutiny that we have to put on some of these companies, but that does not mean that the entire AI trade is over. That doesn't mean that it is a done deal as far as if there's jitters in the markets about the AI trade. You've got UBS that came out this week basically saying overall, the AI trade is still intact. They do not see an investment bubble.
And as I think it's also broadening out, in the last part of that montage we had there, that was Dave Bozeman, CEO of C.H. Robinson, a logistics company. And I spent almost 40 minutes with him listening on how AI is transforming his business. And he has more AI investments planned for next year, which might unlock even more profits. And he's taking this AI and implementing it because that means he doesn't need to add more costly workers. So what I was trying to get at the beginning was this trade is broadening out, and it's not just 7 stocks in it.
No, it's not. I mean, companies are using AI for productivity, and that's what is expected. It'll be interesting to see how that translates into the labor market. But yes, productivity is a major cornerstone of companies that are utilizing AI. And then you've got everything else that touches AI. Of course, we've talked about the electricity grid, the energy grid, all of the entire space that is going to be the energy demand that is going to be needed is really unprecedented. And that's why you're seeing so much money being poured into those sectors.
What does give me pause on the AI trade going into next year? There's no doubt that the growth rates are going to be hot. These companies are going to report earnings and they're going to be big. But will the growth rates be accelerating quarter over quarter? I mean, that's a key piece of context here to the story.
Yeah, certainly you fall into the law of large numbers, right? So look at the massive growth we've seen over the course of the last 3 years in NVIDIA. Of course, it's difficult for them to continue to have 50% earnings growth, 60% revenue growth, and still throw off margins that are north of 65%. So yeah, the larger you get, the more you're invested in this artificial intelligence revolution, the harder it is to continue to push that needle higher. But then at which, what multiple are you trading and how much of that is ascribed to your growth rate? So if you were to take a step back into another century and use a PEG ratio, both Alphabet and NVIDIA are trading at a PEG ratio of less than 1, which basically means they look very attractively valued and don't need that much more growth or multiple expansion to continue to work next year.
And if you are watching and wondering what a PEG ratio is, it is price to earnings growth. But Inez, I think you had a question for me.
Yeah, my question to you was, we talk a lot about affordability going into 2026. That is a cornerstone of the Trump administration and the K-shaped economy. And I guess my question is, how long do you think that this K-shaped economy can continue before it impacts the broader economy and earnings in the market?
Ooh, Inez, that's a really good question. I don't even think we're in a K-shaped economy. I think we're in like one of those lines, and we're on the cusp of going right over into a V and then another line. So I don't even know what letter that is or shape that is. Maybe it's like a heartbeat, Inez. On a screen in a hospital and you see the heartbeat. Maybe we're in a heartbeat economy. I look at the dollar stores, Inez, and these companies have reported some really strong results. And you're not rocking right now if you're a Dollar Tree and Dollar General if the economy is rocking. These companies put up big quarters, the consumer's struggling, and it sounds like they're about ready to fall off a cliff. And it also sounds like every time they try to dip into their digital wallet, they don't have the money to go out there and spend even more, Inez.
Yeah, and I actually have another question too, is basically, is there a trade this year that you thought was really surprising to you?
We will end it on this. Meta. Meta shares only up about 13% year to date. And they've put up good results in Instagram, all the family of apps. Where I think the market is concerned, and this is some of the things that I think Art was talking about, it is the growth in CapEx. This year might spend about $73 billion. Next year, ramp that up to $100 billion. The market is concerned about the return on investment in AI for Meta. They don't see how it's going to fit into a business that is advertising-led. Good questions, Inez. Keep them coming. Art, good to see you. Happy holidays. Thanks for being a friend to Yahoo Finance all year. We appreciate it.
Thank you.
All right, programming note, I am dropping a big new episode of my Opening Bid Unfiltered podcast on Monday with Circle co-founder and CEO Jeremy Allaire. It has been a huge year for the now public Circle. Excited for you to listen or watch this one on Yahoo Finance, YouTube, or any major podcast platform. Coming up, Julie Hyman has you covered for Market Catalyst. We'll be right back.